Okay, good morning. Good morning to the students in class, and good morning to the 29 students that are at home. Before starting with the lecture, I would like to just a reminder, in particular for students that have to retake the accounting pre-course. I repeat again that it is mandatory to pass the exam of the accounting pre-course. The Moodle page for you is a little bit different, of course, but you should see this part that is the exam registration. This is the form that you have to fill out in order to book the reservation for the exam for the next Monday at 2 p.m. Okay? The exam is only through Moodle and WebEx. But it is very important that you first book the exam and second, you pass the exam. Otherwise, it is not possible for you to attend the exam of international GAAP and financial statement analysis. There are some, there is a course that is started UNITO with all the basics of accounting. For students with a strong accounting background, it is not difficult. And here you can see also the mock exam, just in order to have an idea on how the pre-course exam is structured. I repeat again, for us it's very important also in order to organize everything that you register here by Saturday, if I'm not wrong. Okay. Then, if this is clear, I would like to continue. And before continue with the second document of financial statements, that is the statement of profit or loss and comprehensive income, I would like to ask you if you have any questions about what we discussed yesterday. Is it everything clear? So, for example, I can call for a volunteer that explain to the recap to the other students the basics of the balance sheet presentation under IFRS. I'm calling a volunteer. In the classroom, here, in presence. Any volunteer? Keep in mind that when there are no volunteer, I try to push someone to become a volunteer. And it's the same in presence or at home. Now I start with the students that are here in presence, but for the next question, I can call someone that is at home. This is just a way to allow you to review briefly the main concept of the previous lecture. And as I told yesterday, since you don't have so much time in order to study and to understand all the topics, I think that this could help you. So any volunteer here in class? Okay, so I have to push someone to become a volunteer. And for example, here in the first part, the girl in the middle, last row of the first part with the long blonde hair. Okay, the balance sheet under IFRS. What do you remember from yesterday? Very good. Thank you very much. I repeat for students that are at home. Balance sheet under IFRS does not have a rigid layout. IAS 1 simply gives a list of items that in most of the companies can be significant, but then it's up to the company to decide if it is the case or not to aggregate or disaggregate the items. Your colleagues reminded us that the non-financial companies, so for example, manufacturers, companies that provide services, and retailers, and so on, they have to classify assets and liabilities within current and non-current assets and liabilities according to the operating cycle. The operating cycle means that we need to distinguish between operating assets and liabilities that are current if they are directly related to the operating cycle, like trade payables, trade receivables, inventories, VAT receivables and payables, and so on, or non-current if they are linked to more than one operating cycle, typically tangible asset and intangible assets. For assets and liabilities that are not operating, like financial investments, financial assets, mortgages, bonds, and so on, the classification between current and non-current is based on the maturity of these assets and liability. Then your colleagues had also said that for non-financial companies, for financial companies, like for banks, for example, it doesn't make sense to classify assets and liabilities according to the operating cycle. So they simply present assets and liabilities following a liquidity criterion. In most of the cases, they start from the more liquid, for example, cash and cash equivalent, and then they present the assets in order of liquidity. In your opinion, what is the asset that is less liquid compared to the other assets? So assets are cash, receivables, for banks invest financial assets, loans to the customers, investment in securities, tangible asset, intangible asset. The first one, the more liquid, is for sure cash, and the last one, intangible assets. Exactly. Okay. Also Federico in the chat and some students in the classroom. Intangible assets are less liquid than land because it's more difficult to realize some type of intangible assets that in many cases they don't have a market. The same on the other part of the balance sheet. And so there are, of course, liabilities that are due without a maturity, so simply at call. And if we look at the resources obtained by a company, of course, the equity is the resources that, since for equity there is no maturity, the equity is the last type of resources presented in the right side of the balance sheet. Okay? In this course, we do not analyze financial statements of financial institutions because they are too very specific. I will give you some indication about IFRS 9, that is the standard about financial instruments. And as you can imagine, financial instruments for banks are very, very important. But in your project and my examples, we always discuss non-financial companies' financial statements. Okay? Otherwise, it's too difficult to put too many things together. Okay? Any questions? Okay. If everything is clear, we can go to the profit and loss. To be more precise, under IFRS is not only the profit and loss, but it's profit and loss and comprehensive income. In this slide, you can see that under IFRS, and in particular IAS 1, there is a statement that shows the financial performance of the company. The financial performance is divided into two parts. The first one is the profit or loss, or if you prefer, the income statement. You can use the word that you prefer. It's the same, profit or loss or income statement. The meaning is the same. The last line of the profit or loss or income statement is the net profit for the period, or sometimes the net loss. The profit or loss of the income statement is present in all the financial statements of all the local GAAP. So, Italian, Chinese, French, German, US, whatever, Australian, income statement is always present. And it ends always with the net profit or net loss. The other part is called the other comprehensive income. It's a second part of this document. In this other comprehensive income, under IFRS, it is necessary to show some particular gains and losses. Very particular gains and losses, unrealized, so this means that they are the result of a measurement activity, and for which, on the one hand, the IASB, the board, thinks that it is very important to show these gains and losses. But, on the other hand, since these gains and losses are not realized, the board prefers that these gains and losses don't affect the net profit or net loss for the period. So it's a very particular situation, because on the one hand, for sure, the gains and losses presented within the other comprehensive income are gains, are revenue, are losses, are costs, exactly as the other revenue and cost presented in the income statement. But they derive from a measurement activity done at the end of the reporting period, so they are not realized. There is a question mark about the future realization. And for these reasons, the board obliges the company to present this type of gains and losses within a specific section. In this way, it is possible to have, on the one hand, the total performance of the company, the total comprehensive income, as the sum of the net income, the net profit, net loss presented in the income statement, plus all the other comprehensive income. But it is possible also to have a net profit and net loss that is not affected by these gains and losses. Okay, now I'll give you some examples. Under IAS 1, it is possible to present a single statement of profit and loss and comprehensive income with two separate sections, left side of the slide. Or it is possible to present two different statements, the statement of profit and loss and the statement of comprehensive income. It's just a matter of how the documents are presented. A single big document with two sections or two separate documents. Italian companies, French companies, German companies, they prefer the second type of presentation, two separate statements. For English companies, some of them present a single big statement with two sections. There is someone with the microphone on, please. Thank you. Okay, so it's just a matter of presentation. Now, instead of saying too many things, it could be useful to have a look, for example, at E&I financial statements at page 186. There is the consolidated financial statements. Yesterday we have a look at the balance sheet. Today we have a look at the other documents, and in particular profit and loss and other comprehensive income. So for E&I, as you can see, E&I starts from the income statement that is completely separated from the statement of comprehensive income. Look at the profit and loss. Here there is the profit and loss for the period. And in particular, as you can see, a loss in 2020, a loss of 8,600,000,000. Okay? A profit of 155 million in 2019, and a net profit of 4.137 million euros in 2018. The last line of the income statement, profit and loss, it's also the first line of the second document, because the financial performance of the company is composed of the two parts, the net profit, net loss on the one hand, plus other comprehensive income or losses. Okay? And these other comprehensive income or losses for E&I 2020, as you can see, the total amount is again negative, so losses, other losses, for 2.7 billion. So this means that the total comprehensive, the total performance of the E&I for 2020 is a loss of 11.4 billion. Whereas in 2019, a profit of 224 million, composed of two parts, 155 million of net profit and 69 million of other comprehensive income, other gains, other losses that the company is obliged to show in the second part of the statement of financial performance. Is this clear for everybody? During this course, we will focus mainly on the first document, the income statement, the profit and loss. But for some topic, it is necessary to have a look also at the other comprehensive income. I would like to analyze with you. There is a question in the chat. I would like to analyze with you the most important. The most important item of this other comprehensive income. Okay, look at 2020. The total is a loss of other comprehensive income of 2.7 billion. The most important, the most significant items is the one that I have highlighted in blue. Currency translation differences. And as you can see, negative for 3.3 billion in 2020, positive for 604 million, positive for 1.7 billion. What is the origin of these differences? Keep in mind that this is a consolidated financial statements. Okay? Consolidated financial statements means, as I told you yesterday, then when we draw up the consolidated financial statement, we need to put together financial statements of Eni and financial statements of all its subsidiaries. Some subsidiaries use the euro as currency for the presentation of their figures. But some other subsidiaries, they use other currencies, US dollars or other in Norway, the krone, if I'm not wrong. And so the problem is that the consolidated financial statement is presented in euro. So when Eni sum up all the financial statements of all the subsidiaries, Eni needs to translate the balance sheet and the income statement of all the subsidiaries that don't use the euro into euro. And this process generates differences. These differences are not recognized in the income statement because they are not realized. Because Eni holds some subsidiaries for decades, for many, many, many years. So it doesn't make sense to recognize these losses and these gains in the income statements. They are very volatile. There are fluctuations that can be very, very strong. And so, on the one hand, it is necessary to translate these financial statements into euros. And so, unfortunately, there are these differences. But they are not presented within the income statement, but presented within the other comprehensive income. Okay? And here you can see the effect, a very strong effect. Viola, in Italy, I think that it's quite impossible to find a company that presents a single statement. And this is also the preferred presentation in France and in other European countries, let me say continental, so Spain, Germany, and so on. English companies, if we look at the United Kingdom, there are some companies that use a single statement. But for example, for the Italian companies, it's impossible. If I'm not wrong, I'm not able to give you an example of a company that presents a single statement with profit and loss and comprehensive income. They prefer to present two statements. This is British Petroleum. Consolidated financial statement is page 129. And sorry, but you can see here, this is the table of content. Of course, blue on blue is not a good idea, but as you can see in the table of content, it is clear that also for British Petroleum, these statements are two: income statement and statement of comprehensive income. Okay, and if we go there, this is the income statement. In the income statement, we have profit or loss for the year, a big loss also for British Petroleum in 2020, and statement of comprehensive income. First item that is the same as the last item of the income statement, net loss of 20 billion. Then all the other comprehensive income. Also for British Petroleum in 2020, the other comprehensive income are a loss. And so the final result, the total comprehensive income, that is the sum of profit and loss for the period, other comprehensive income. As you can see, also for British Petroleum, the most significant other comprehensive income is due to the currency translation differences. So again, but in this case, okay, in this case, the presentation currency is not the euro, but it is the US dollars. Okay, is this clear for everybody? Any questions? And this is the, if we want, you can have a look at the other comprehensive income statements, but more or less the presentation is exactly the same. I repeat again that in the other comprehensive income is not the company that can choose the loss and gains that are presented within the other comprehensive income. They are mandatory according to specific standards. First of all the translation linked to subsidiaries that have a currency other than the consolidated currency used for the presentation of the consolidated financial statements. And then there are other specific situations, very particular situations. Some of these linked, for example, you can see here, to derivatives and hedge activity, so very particular activity. If you don't have any particular questions, we can move to the profit or loss statement or income statement that is present all over the world, not only under IFRS. And again, under IFRS, the layout is completely free. There is a list of items, again, as for the balance sheet, but in the case of profit and loss statement, this list is very, 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 very short. As you can see, there is revenue, and then finance cost. But in an income statement, from revenue to finance costs, in the middle, there is everything. Okay? So this means that according to IFRS, It's the company that is completely free to choose how to present all the operating costs. And in particular, for cost, the company can choose between two different classifications. Cost can be presented according to their nature or according to their function. It's up to the company to decide which is the classification that, according to the business, to the industry, it's the more reliable and relevant classification. Okay? I have some questions for you. And we start with nature. The color is always the same. Nature. Could you give me, please, some examples of costs classified according to their nature? This is a question for students at home and here in class. If I say costs are classified according to their nature, what do you expect to find in the income statement? What type of items? Sorry? Wages, for example. So cost of personnel, general. Okay, salaries, wages, cost of personnel. Then depreciation of machinery, for example, depreciation of plants. Then, someone at home? So, cost of personnel, depreciation, cost of raw materials, so cost of purchase for raw materials. Then services, okay? So when the classification is according to the nature, costs are presented according to the type. So the information is about the nature of the input acquired by the company. Cost of personnel, cost for raw materials, cost for services, cost for depreciation. So nature, we don't know the use of these inputs, but we know the inputs. Okay? Function means that we are not interested in knowing the type of inputs acquired by the company, but we are interested, or we know if the function classification is used, we know the function, so the use, so where the company has used the inputs. So when marketing, administrative expenses, selling and distribution expenses are presented, this is a classification according to the function of cost. Because if we read in an income statement administrative expenses, we don't know how much of those expenses are for personnel, how much are for services, how much are for depreciation. We don't know. We don't have this information. Because when cost of goods sold, marketing expenses, administrative expenses, distribution expenses, here the focus is on the purpose of these inputs, where the company has used the inputs for the production, cost of sales or cost of goods sold, for the distribution, for the administrative activity, and so on. Is this clear for everybody? It's completely up to the company that should decide if it is better to present cost according to their nature or according to their function, according to the more reliable and relevant information. Okay? Is clear for everybody? Then we have, of course, the income taxes, sorry. And then there is again a very particular part linked to the consolidated financial statement, and we will discuss it next week. Now, I would like to present you E&I profit and loss. Okay, have a look at this income statement, at this profit and loss, and tell me if costs are presented according to nature or function. Okay, 3 students at home, more than 3, nature. What about here in the classroom? Nature. Okay, this is easy in this case because there are purchases, services, and others. Then payroll and related costs, so personal costs. There are depreciation and amortization and some other items, all linked to tangible and intangible assets. Okay, so nature. In this case, E&I presents revenues and some other items. So sales from operations and some other less significant revenue. Then there are the costs classified according to their nature, and E&I presents an intermediate result that is the operating profit and loss. Another important thing. Under IFRS, intermediate results are not mandatory. So it's up to the company to decide if it is an information that is useful to present an intermediate result, like in the case of E&I, the operating profit for 2020, an operating loss. Okay? So it is not mandatory, because if we go back to the slide, as you can see in the list, that is an example, but we have revenue, finance cost. There are no intermediate results that are mandatory. So operating profit, EBIT, EBITDA, gross profit, gross margin, they are not mandatory. Okay? This is E&I. So revenues for 44.9 billion minus costs presented according to their nature, an operating loss of 3.2 billion, then finance income and finance expenses. The net result is expenses, interest paid by E&I. And then, look, a particular item, very particular item, that is share of profit from equity accounted investment. Very particular items that is linked to the consolidated financial statements. I go back, I would like just to show you Here. Yesterday, I presented this slide. Do you remember? Okay. This slide is the picture of a group. There is the parent company and all the subsidiaries. The subsidiaries are presented in the consolidated financial statement, line by line. Okay, so we don't see the investment, but we read assets, liabilities, revenue, and cost of all the subsidiaries. But look at this slide. There is a particular situation that is the situation of A. A is an associate. The group in this case does not control A. Look at the amount of shares that are held. Only 21%. 21% is not so low amount of shares, but it is, generally speaking, not enough in order to control. So an associate is an entity over which the parent company has a significant influence. In this case, A is presented in the consolidated financial statement with a particular method that is the equity method. Yesterday, when we had a look at the list of assets presented by IAS 1, there was an item invested, accounted for using the equity method. There are mainly associate and other type of similar investment. I would like to give you just an example. Suppose that the company H, like in this case, has a 20% of company A. So company A is an associate. Okay? This means that in the consolidated financial statements, A is measured according to the equity method. Equity method. So suppose, for example, that the initial cost was 100. So the amount paid by H in order to acquire the 20% of A. Is this clear for everybody? At the end of each reporting period, the investment in A is measured according to the equity of A. Okay? So suppose that at the end of year 1, suppose that the total equity of A is 1,200. This is the total equity of A. H owns the 20% of A. So my question is, how much is the amount of the investment in A shown in the consolidated balance sheet of the group if the method used is the equity method? How much is the amount shown in the consolidated balance sheet if the total equity of A, this is the total equity of A at the end of year 1, is 1,200. How much is the amount shown in the balance sheet? It's the 20% of 1,200. Okay? So in the consolidated balance sheet, at the end of year 1, the investment in A is accounted for using the equity method, and it is shown at 20% of 1,200. So 240, as some of your colleagues has just written in the chat. But if the cost was 100, and now in the balance sheet the investment is presented at 240, in the income statement we need to recognize the share of the net profit of A. And if we make an hypothesis, of course, that the increase from 100 to 240 is due only to the net profit of A, this means that in the income statement we have 140. That is, if in this very simple example, this is the 20% of profit of A. Okay? Of course, it's a little bit more complicated, this method. But for me, what is important is the mechanism in general that must be clear. So there is an associate, or this method is used also for joint ventures. So when the control is shared, and this means that in the balance sheet, the investment is maintained. In the income statement, we need to disclose the share of the net profit of A. In our example, the 20% of net profit of A. And if the increase from the cost to the amount at the end of the period is due only to the net profit, this means that in the net profit we have 140. Is this clear? At the end of the lecture, I will post all the Excel file using during classes. Okay? It's just like a whiteboard, but I think that in this way it is better because it is not handwritten. Okay? So, if we go back to E&I, look the balance sheet. Equity accounted investment. Okay? 9 billion at the end of 2019, 6.7 billion in 2020. Equity accounted investment. If you go to the note 15, you can also see the name and what type of the name of these investments. But they are associate and joint ventures. 6.7 billion means that this is the percentage of shares held by E&I multiplied by the equity of associate and investment. Now, if we go to the income statement, here share of profit, loss from equity accounted investment. Look at the sign. Loss. Okay? This 1.7 billion loss means that this is the percentage, the share of net losses of E&I in its associate and joint ventures. Is this clear? If it is not clear, please ask for clarification. Okay? Please look where this share is presented. Okay? There are revenue, operating costs, there is an operating profit, all the finance income and expenses, and then this share of losses, unfortunately, in 2020. Then there are the earnings before taxes, that is a loss, income taxes, and the total loss for the period. Okay? Now, British Petroleum. The industry is the same. Okay? But look at how the figures, the numbers are presented. Sales and other operating revenue. And this is as for E&I, the first item. But then there are two items in yellow. Earnings from joint ventures, earnings from associate. Okay? Loss, 302 million and 101 million. This is the same as for it's difficult to go. Come faccio ad andare? Sorry. Faccio tornare lì. Però it's not so. Okay. This is E&I. And look, the amount is there. It's not close to the revenue. Are you able to see the difference, the big difference between the two income statements? British Petroleum, revenue, and then close to the revenue, there is the share of net profit or net loss of associate and joint venture. Look at for E&I, revenue, cost, finance income and expenses, and then only in the second part of the income statement, the share of profit and loss from equity accounted investments. But the income statement is always the income statement. They both use IFRS in order to present their income statement. But since the layout is not rigid and they can do whatever they want, as you can see, the presentation is completely different. Look, the costs are classified according to the nature, also in the case of British Petroleum. Okay, purchases, depreciation. Even if it is not clear, for example, the amount of the cost of personnel. There is production and manufacturing expenses. It's over there. In this case, it's a mix because we have purchases, depreciation, nature. We don't see the cost of personnel, and we have the distribution and administrative expenses. So in the case of British Petroleum, the classification of cost is mixed, part according to their nature, part according to their function. Is this clear? And then there is these intermediate results that is the profit and loss before interest and taxation. Sort of EBIT, okay? Earnings before interest and taxation. Minus 21 billion. E&I presents the operating profit and loss. Pay attention when you read financial statements under IFRS, because operating profit, EBIT, they seem the same. Keep in mind, they are not defined by IFRS. So if you compare the two companies, for example, you cannot use the data as presented by the two companies, because for E&I, the operating profit does not include the share of the equity accounted investments, joint ventures and associate. And it is significant, this amount, because it's a loss of 1.7 billion that if we want to compare BP and E&I, we cannot compare minus 3.2 with minus 21 billion. But we need to adjust the amount of E&I in order to consider also the 1.7 loss of share from equity accounted investment. Or the opposite. We need to eliminate from these 20.1 billion the earnings from joint ventures and associates. Otherwise, the two results are not comparable. Is this clear for everybody? So the balance sheet, the layout is not rigid, okay? But at the end, current and non-current assets and liabilities, yes, there are some differences, but not so significant. For the income statement is the description, the depiction of the business of the company. And since it's completely free, no intermediate results are mandatory, no intermediate results are defined. So it's completely up to the company. When you read income statement, you have to pay attention. Otherwise, the same name could be determined, including or not including completely different revenue and cost. This is the important message for you. Any questions? If we look FCA, this is FCA financial statements. Again, also in the case of FCA, two different statements and not just one. Please read nature or function for the cost. In case of FCA, nature or function. Nature or function? Function, okay? Cost of revenues, selling, general and other costs, research and development costs, then result from investment, of which, again, as you can see, share of the profit of equity method investee, the same, associate and joint ventures, gains on disposal of investment, restructuring cost, net financial expenses, profit before taxes, tax expenses, and then net profit. Okay? Classification according to the function, and as you can see, just one intermediate result, that is profit before taxes, nothing else. This is PSA, page 40, if I'm not wrong. This is the income statement of PSA. Revenue, also for PSA, costs classified according to their function. FCA used cost of revenues, PSA cost of goods and services sold, but at the end it's the same. Selling, general and administrative, research and development, restructuring costs, impairment, that is losses for tangible assets. But in the case of PSA, there is an intermediate result, operating income losses. Then the net financial income expenses. There is another intermediate result here, income before tax of subsidiaries. Then here, share of net earnings, in net earnings of, again, associate and joint ventures, in a different position compared to E&I, FCA, and British Petroleum. So again, as you can see, the income statement is always for the four companies is according to IAS 1, so it is compliant to IAS 1, but the presentation is completely different. Is this clear for everybody? Any questions? So, the message is to be careful when you read income statement, in order to understand the type of classification used and where some particular items are presented, because this could change completely the intermediate results presented by the company. Okay? Do you like this type of presentation or not? Do you like this freedom that company have in order to present their income statement or not? What is your opinion? Do you like it or not? Students that have attended, for example, an Italian degree at the University of Turin, they have analyzed the income statement according to the Italian GAAP. Or maybe there are some other students from other European companies, and generally speaking, Italian GAAP, French GAAP, German GAAP, Spanish GAAP, and so on, for all the European Union, the layout is not free. The layout is rigid. So companies belonging to completely different industries, they have to present the income statement using the same layout, the same, okay? And this means that, on the one hand, if the layout is the same, it is easiest to compare the companies, and in particular, the operating profit. As Adela has written in the chat, under IFRS, on the one hand, the companies are free to present their results according to, in theory, according to how the management uses the result inside the company. Okay? But for analysts, it's very, very, very difficult to compare the operating profit of different companies. And as you can see, of course, it doesn't make sense to compare FCA and PSA to British Petroleum and E&I. But it is difficult to compare British Petroleum and Eni, FCA and PSA, because the layout is free, and so it is not so easy to identify an operating profit. For this reason, this is the website of the IFRS organization, projects, and if we go to the work plan, there is an important project, that is this one, primary financial statements, okay? And it's a project that the company, that the board started some years ago. In December 2019, the board published an exposure draft. At the end, the most important goal of this project is to oblige companies to present at least some subtotals that are equal, that are the same for all the companies. So this problem, the fact that it is difficult to compare operating profit of companies, even if they belong to the same sector, industry, because it's completely free, this is something that also the users, do you remember the users, shareholders, lenders, creditors, they told the board, dear member board, it's difficult to compare income statements. So the board has started some years ago a project in order to identify at least one intermediate result. And second, to define where the share of the profit of associate and joint ventures must be presented. Otherwise, results are not comparable. Is this clear for everybody? Of course, Viola, you can decide by yourself what is the configuration of operating profit that you prefer. And so this means that you can recalculate, aggregate and disaggregate the figures presented by companies in order to identify the operating profit that for you is relevant, you as an analyst, I mean. Of course, sometimes it is possible, some other it is not. It depends on how the figures are presented. So what you suggest, it's of course a way that now it is mandatory to follow if we want to compare two companies because of the absence of intermediate result under IFRS. Of course, with this project, the board intends to eliminate this problem by obliging the companies at least to present at least one intermediate result and to present the share of net profit of associate and the joint ventures in the same position. Is this clear for everybody, Viola? Okay. Very good. So the second activity that you have to do when you start to read the financial statements for your project work is to analyze the balance sheet, and you have to analyze the income statement. As you can imagine, for the balance sheet, I don't expect too many peculiarities. For the income statement, it's completely different. Okay? And in these slides, there is just a recap of the other comprehensive income. They are the same presented by the companies that we have analyzed together. In particular, we focused on the differences arising from translation of foreign subsidiaries. You are not requested to memorize, to learn by heart this list. Okay, it doesn't make sense, but it's just in order to have the idea of this other comprehensive income. There are some other documents. Statement of changes in equity. Statement of changes in equity. So it's a document that helps the users to understand reasons for changes in equity from the beginning of the period to the end of the period. And first of all, the equity increases or decreases due to the financial performance of the company. Net profit, net loss, but keep in mind, we are in the IFRS, so it's not only net profit, net loss, but it's also the other comprehensive income, because the financial performance is the sum of net profit, net loss, and other comprehensive income. Then there are other impacts. In particular, interest in this one. Equity can change, for example, for contribution from the shareholders. In this case, there is an increase in equity, but it is possible to have also the opposite situation, a decrease in equity due to dividends paid to shareholders. Okay? And with the exercise of this afternoon, you will have the opportunity to review how the equity changes in equity work. If we use E&I, statement of changes in equity. As you can see, the starting point is the equity at the end of the previous period, at the end of December 2019. The equity, the total equity that for E&I is 47.8 billion, is divided, presented in different accounts. Too many. Share capital, retained earnings, and then, for example, here, the cumulative effects of translation of subsidiaries and other, in particular, the net profit for the period. Okay? This is the amount at the beginning of the period. The equity is decreasing because of the net loss for the period. Do you remember the total amount of the loss of E&I? 8.6 billion. So the equity that at the beginning was 47 billion, in 2020 decreases of 8.6 billion due to the loss for the period, but also of other 2.8 billion. Where are you? The total is here. Because of the other comprehensive income. The total performance is negative of 11 billion. These figures are the same shown in this document, as you can see. Okay? Net profit, 8 billion, 0.6 net loss, sorry, not net profit. Other comprehensive income that are a loss, total comprehensive income, 11.5 billion. These are the mainly reason, the most important reason for the total equity, for equity moving from 47.9 billion to 37.4 billion at the end of the reporting period. Is this clear for everybody? But there is another important items that are dividends paid. Okay. So Eni during 2020 paid dividends to its shareholders, and this means that, of course, this is a reduction in equity. Is this clear for everybody? Please tell me something from the students that are at home, in the chat. Is everything clear? So, statement of changes in equity. We start from the beginning. The main reason is the total comprehensive income. In case of Eni, it's a reduction because it's a loss. But during 2020, Eni distributed dividends for 2 billion or less, so another decrease. And then there is the issuance of some particular instruments that are similar to equity for 3 billion. So this is why at the end the equity is 37. So if we go to the balance sheet, in the balance sheet we have the total equity. We have total equity. I would like to use my computer, but it is not possible in this situation because with my computer I know everything, the function and so on. Each computer, every computer is different. So the equity is 47.9, 37.4. In the balance sheet, you simply see the total amount, beginning, end of the period. Profit and loss, you see the net loss. In the other comprehensive income, you see the total comprehensive loss of 11 billion, but only in the statement of changes in equity, you can realize that there are also dividends distributed and a contribution because of a particular instrument that was issued by Eni. Without the statement of changes in equity, it is not possible to understand all the movements because you can understand only the change due to the financial performance, but you are not able to see changes due to the movement with the shareholders. Is this clear for everybody? Then, cash flow statement. This is the analysis and the construction of cash flow statement is part of, will be discussed during part 2 with Professor Resarta Scurti. Here I would like only to highlight that. Keep in mind, different GAAP, different accounting standards, different estimates, different net profit, net loss, and equity. Keep in mind, you cannot compare financial statements prepared by an Italian company according to the Italian GAAP to financial statements prepared by another company using IFRS. It doesn't make sense to compare the net profit. It doesn't make sense to compare the equity because net profit and equity are the results of measurement, of estimates. Italian GAAP, IFRS, US GAAP, French GAAP, different measurements, different estimates, different results. It is clear for everybody? In 2004, TIM is the Italian company in the telecom, not the only one, but for sure it's the oldest, the incumbent company. In 2004, TIM presented a net profit according to the Italian GAAP of 1.2 billion euros. Same period, same group, but net profit according to IFRS, 2.23 billion of net profit. So the company, the group was the same. The transaction conducted in the year were the same. But in 2004, the net profit according to the Italian GAAP, 1.3 billion euros. Net profit according to IFRS, 2.3 billion. So 1 billion more in the net profit. Is this clear for everybody? This is very important, okay? This means that you cannot compare companies that use different accounting standards. But there is a document that you can compare, and it is the cash flow statement, because cash movements, the cash in and cash out, are not affected by estimates. In the cash flow statement, a company presents the cash generated and the cash used, and cash is not subject to an estimate. Is this clear for everybody? So cash flow statement cannot be affected by the accounting policies. In fact, the cash flow statement highlights the cash at the beginning of the period, the cash at the end of the period. These amounts, we can read them in the balance sheet. And it is easy, of course, to make a difference. The information provided by the cash flow statement is on how the company has generated this decrease or increase. And under IFRS, and in particular IAS 7, cash flows are classified within 3 categories: operating activities, investing activities, financing activities. Operating activities means all the cash flows directly related to the core business of the company. So cash collected from customers, cash paid to suppliers, to employees, to the government for taxes, and so on. Investing activities, all the cash flows due to buying and selling plant, property, equipment, intangible assets, financial investments, and so on. So the investment in general. Financing activities means cash generated and used for all the financing activity. This means when the company obtains money from banks, for example, the repayment of mortgages, the contribution from shareholders, the dividends paid to shareholders. Okay? In the first part of the course, you are just requested to be able to classify the cash flows, inflows and outflows within these categories. During the second part of the course, you will understand a little bit better the technicalities, in particular the technicalities of the operating activities. But for right now, what is important, so it's not to analyze all these items, but simply, this is E&I again, net cash provided by operating activities, 4.8 billion. This is the difference between the cash collected from customers and all the payments to suppliers and personnel, employees, for taxes and so on. Then, net cash used in investing activities. Okay, investing activities means for E&I, as you can see, buying and so paying tangible assets and other assets. But as you can see, the most important investment for E&I is in tangible assets. So look, 4.8 billion of cash generated by the operating activity, but of which 4.6 used in order to buy mainly tangible assets. What about the financing activities? Financing activities. In 2020, cash generated, but as you can see, almost 2 billion of cash paid for dividends. Then 3 billion, more or less, of cash obtained by the issuance of these subordinated bonds. And then here, all the movement of financial liabilities, so increasing long-term financial debt, means that during 2020, E&I obtained new cash for 5.2 billion from the banks. But in the meantime, E&I was obliged to pay back 3.1 billion of cash because of previous long-term financial debt. Okay? As you can see here, we can understand the cash at the beginning of the period, 6 billion, 5.9. Cash at the end of the period, 9.4. The net increase is 3.4. But simply by reading the balance sheet, we cannot understand the origin of this increase. Here we can. And at the end, since more or less the cash generated by the operating activity is almost used only for investing activities, the increase in cash is due to the financing activity, that is, cash obtained by E&I, mainly by this issuance of these bonds. This 3 million is there, the origin. Okay? So in this part of the course, what is important is that you are able to classify the inflows and outflows within the different categories. During the second part, you will focus on the analysis and, in particular, on this part. So how to determine this 4.8 billion of the operating activity when the indirect method, like in this case, is used. Okay? But right now, focus only on the meaning and the most important, the effect of the most important transactions. The last document, then the break, the notes. Notes means the narrative part of financial statements, very important. Otherwise, it is not possible to understand, for example, the accounting basis used, the accounting policies. It is not it is not possible to understand the content of the different items. Keep in mind that under IFRS is mandatory to cross-reference the items in the financial statements, in particular balance sheet and income statement, in order to be able to allow users to easily find the notes. And this means, for example, again, E&I, look at the income statement. Here there are the notes. Okay? It is mandatory to use the cross-reference in order to allow, same here. This is not a choice of E&I, but it is mandatory. In fact, we find the notes also in all the other companies. Okay? Then, the manner of presentation of the notes, it's up to the single companies. Stellantis as E&I, for example. Probably for Stellantis it is better. Okay. Look at the content. Okay. These are the notes of Stellantis. There is the first part, number 1 and number 2, are very, very general. They are useful for you because you can read that part. It's a sort of recap, a sort of summary of all the standards used. So the IAS 16 or plant property and so on. Then there is a part dedicated to the scope of consolidation. And then all the other notes, they are specific for the contents. For example, perché adesso non funziona? Perché c'ho questo classificato? Via. For example, research and development. Okay, as you can see here, you don't read the accounting policy. You simply read the content of the research and development cost. Okay, this manner of presentation is very, very common for Italian companies. So a first part, let me say, theoric is not right, but just a narrative description, the first part of all the items of the financial statements, and then the contents. Look at the first part. Okay, this is the part of description. As you can see, narrative, words. Okay, no figures. For PSA, the notes are presented in a completely different way because the accounting policies are just highlighted, and then for each, for example, important topic, there is okay, like in this case, revenue, the narrative part, and immediately below the figures. Okay, so the notes of PSA is completely different compared to the note of FCA, because for FCA there is a very long part that is only narrative, where FCA describes the accounting policies of everything, revenue, cost, assets, liability, all in the first part, and then the second part with the figures, with the numbers. For PSA, generally speaking, for French companies, the two parts are close. So, for example, for revenue, there is the description, narrative part, and immediately below, the figures. And the same, for example, research and development expenses, the description, and the content. Okay? Personally, I prefer this type of notes. But for many companies, in particular Italian companies, but not only Italian companies, the traditional notes were the other one, and so they continue to present this very long, boring narrative part, and then the figures. For the users, it is, this is my opinion, it is better this type of notes because it is easier to compare the narrative, the description of the accounting policy, and then the effect. Okay? Any questions? I think that now your only goal is to have a break. So a break of 20 minutes starting from now.